Well, it really has been a rough time for investors, especially those who've put their money in the share market. While Chinese shares bore the brunt of the falls in the first 2 weeks of 2015, international and Australian shares are both down around 7%. But the average super fund has only declined 2.5%. It may be hard to ignore the headlines, but investors are being advised to keep a cool head.
The danger is to chop and change based on what you think markets are doing. That's the worst possible strategy.
The share market is just one of many investment asset classes used to build super.
You're invested in shares, property, bonds, cash, and a whole range of other investments. So you're not putting all your eggs in one basket.
It's one of the reasons why super funds, while down, have outperformed global equities in the first 2 weeks of 2016.
It's absolutely not time to panic. The short-term volatility may or may not have an impact on the long term.
It's little comfort for some who've checked their super balance accounts following a lacklustre year. Researchers at Chant West are predicting the average super fund grew by just 5% in 2015.
But you need to keep in mind that 3 previous years, you got returns of about 35 or 40% in total during those years.
Over the long term, super funds grew much more than they fell.
The vast majority of people, when they retire, don't take their lump sum and spend it. They look for that income stream.
Which shares may offer.
Even though the value of the assets go up and down, the dividend income from shares generally is fairly steady. And most people in retirement do rely on that dividend income.
For those still worried about the short-term volatility,
They should check back in with their advisor to see how their long-term retirement goals are being impacted, if at all.